Regulators are trying to avoid another bailout. Mortgage applications are plunging, and AIG is officially a threat to society. You're in the right place, folks, because this is where the money is.
Matt, yesterday we got proposed capital rules for the banks from the OCC, the FDIC, the Fed, basically proposing to drastically increase the capital that the biggest banks in the U.S. hold. What does this mean to investors? Is this a concern for you over the long term?
It's concerning to some extent. I think what we're going to have to look for is how exactly this shakes out and what impact it has on the market. So on the one hand, anytime the banks are going to have to hold on to more capital, that's going to potentially reduce returns because capital that they have to hold on to, they're not investing in something, they're not loaning out, they're not making money on that capital. However, there could be some intended or unintended positives to this. We were talking beforehand, and you mentioned the possibility that the market could start to see the banks as less risky, and that could be a benefit to them. That could lead to lower funding costs and that kind of thing, and that could actually help them.
Right. I mean, you look at the banks that are proposed to get hit, and they are the biggest banks. I look at a bank like Wells Fargo. Right now, they fit the proposed what the regulators are proposing, that
supposedly, the whole thing isn't all that clear. It sounds like they're taking total assets here as opposed to risk-weighted assets, which is the way banks typically do it now, and they're going to be looking at total assets. So that makes it even more strange.
Right. So assuming that those assumptions are correct, and Wells Fargo does fit those assumptions now, they're still producing great returns. They're still producing double-digit returns on equity, and as a long-term investor, yes, higher capital may reduce returns a little bit, but if the business of banking is still fairly attractive if you have a well-run bank that can continue to produce returns on equity in double-digit range. So over the long term, I don't see this as too big of a deal. I think banks there's going to be some back and forth. I'm sure they'll have some things to say that they shouldn't hold that much capital. But over the long term, I think there's still going to be opportunity in the banks.
I think banking is a very attractive business. Let me just say that. Now, in terms of when we're talking about who's going to get hit with this, we've got the big four: JP Morgan, Wells Fargo, Bank of America, and Citigroup. Bank of New York Mellon will be up in there. They said that they're looking at any bank that has more than $10 trillion in assets under custody. Bank of New York Mellon actually has $26.3 trillion in assets under custody and management. Now, one thing that I think will be interesting when March rolls around next year and we've got the CCAR from the Fed, the stress test from the Fed coming around again, it could be interesting to look at where the leverage ratios fall in the banks. Again, last year, as far as I could tell, they were using risk-weighted assets, so risk-weighted leverage ratios. But still, I think it's kind of interesting to look back on that. JP Morgan's Tier 1 common leverage ratio fell to 4.7% under at a minimum, under the stressed scenario that the Fed looked at. And so that 4.7% would fall under the 5% level. Now again, we may be comparing apples to oranges a little bit here, but JP Morgan may be one that would have to boost capital a little bit more than others. Goldman Sachs's leverage ratio under the CCAR last year fell to 3.9%. So again, maybe a strange comparison depending on how you measure it, but another bank that may be more prepared to have to add capital to its buffer.
Right.
So heading to mortgages, we saw a kind of a wonky report from the Mortgage Banker Association last week. On a seasonally adjusted basis, mortgage applications fell 4% week over week. On a not seasonally adjusted basis, they fell 23%. Now, I think to some extent the report is a little bit meaningless because we had the holiday last week and it was
people at the beach instead of their mortgage banker's office.
Exactly. Although being in a mortgage banker's office is great, but out seeing the fireworks is maybe a little bit better. And I think because of where the holiday fell during the week, it was the entire week was largely a wash.
Right.
But in any case, you were telling me that refinance applications have fallen 50% over the last 9 weeks.
I mean, it's really just the fact that rates are rising. That's really what you can attribute to. The conforming mortgage, 30-year mortgage, is up to almost 4.7%. It's a 2-year high. And this is going to be really interesting when we see the banks start to report earnings. We have Wells Fargo, JP Morgan reporting on Friday. They're the two biggest mortgage originators in the country. And then Bank of America next Wednesday. So you mentioned refinancing is falling. In the first quarter, 91% of mortgage originations at Bank of America were refinanced. So if refinancing is falling and that's the majority of their mortgage originations. It might be a little bit of an ugly quarter in the second quarter for Bank of America. On the other hand, Wells Fargo, only 65% of their first quarter originations were refinances, so they might have a little bit more leeway as purchase.
Just to play devil's advocate with you there, on the flip side, Bank of America has trailed the group in terms of coming back into the mortgage fee business, and so the overall impact of mortgage origination fees on Bank of America's P&L is going to be much smaller than Wells Fargo or JP Morgan. Wells Fargo, what was it? I think it was like something like $8 billion first quarter, or was that all of last year?
I think that was all of last year. It was roughly $12 billion, I think.
Okay. In any case, huge amount of fee income from mortgage originations. Bank of America, we could complain that they've been slow to keep up with everybody else, but on the other hand, as apps start to fall or continue to fall, and we see that fee income drop off, Bank of America is maybe hurt less than everybody else. Although, like you said, refinance applications as a percentage of their overall fee income, that's going to hurt a little bit.
Absolutely.
Looking at the new SIFI designations, we now officially have AIG and GE Capital called significant institutions in terms of being a threat to the financial system. What do you think about this? Is this something that investors should be concerned about?
I don't think anyone's surprised by that. Obviously, AIG is systematically important to the financial world, and I think Prudential was the other one that was thrown into the group. But I think they're actually going to challenge the designation. I guess they don't want the stigma.
They've been fighting it all the way along.
Exactly, but just like the banks, I don't see this as that big of a deal long term. Insurance companies are obviously a little bit different than banks, and long term, just because they have this stamp, yes, they're going to have to go through a little more hoops and jumps over the long term. But as an AIG shareholder, I don't see this as a big deal, especially with AIG, the investment thesis. It's really, what's their insurance business doing? Are they still operating profitably? Not as much trying to squeeze every little bit out of their capital. What do you think?
I think it's stupid.
Just leave it at that?
I frankly think it's stupid. I think it's really backward looking. In the case of AIG, when we look at the threat that it posed to the financial system during the financial crisis, it was all the financial products unit. It was primarily, maybe 100% the financial products
unit. Now they're not even doing it.
It's wound that down. It got rid of that unit. I think in setting these SIFI designations, looking back at who got the biggest bailouts, who posed the biggest threat during the financial crisis, I think that they feel like they had to call AIG a SIFI.
So you see it as a little more grandstanding than something that's really going to impact AIG's business.
Yeah, they claim that the life insurance business, well, there are a lot of investments there, and if they had to liquidate those quickly, I think that's hogwash. I don't think AIG is a threat to the financial system anymore. Could it be again someday? Potentially, if they started to do stupid things again. But right now, I don't think so. But it doesn't surprise me that they got designated a SIFI.
I agree.
Small investment banks. We talk a lot about the Goldman Sachs of the world, the Morgan Stanleys of the world, but there are some much smaller, kind of referred to as boutique investment banks out there. Are these potentially good investments?
The one that was in the news this morning was Evercore, and they announced that they're entering the private capital advisory business, so working with private equity. They're going to be competing with Greenhill and Lazard, the bigger of the boutiques out there in this space. When I look at these three investment banks, on one hand, I like their strategy. They're very specialized. When you're just doing investment bank advisor, it's not a hugely risky business. You can almost think of them as consulting companies, not necessarily trading companies. So on that hand, it gets me interested, but I just don't know how much they can compete with a Goldman Sachs, a Morgan Stanley, especially if we're in this new environment where capital rules are more important to these bigger investment banks, and they really need to focus on those fee businesses. So I just wonder how much a Greenhill or an Evercore can really compete. Yes, they certainly have smart people at those companies, but I don't know if they can compete with the breadth of services from a Goldman Sachs or Morgan Stanley.
I think they'll compete very well. When I think about the smaller boutique banks, the great thing about them is that they specialize in certain areas, and so when you have clients out there looking for a particular thing, those particular banks can be very attractive. Lazard, for instance, very well known for its restructuring practice. Greenhill, very strong business over in Europe. So, Goldman has a big breadth of services, and they can offer certain things that or a lot of things potentially that a Greenhill or a Lazard or an Evercore can't. But one of the other things too is the attention and the service. At Goldman, again, you have a big company and they're serving some of the largest clients in the world. So if you're let's say you're a $1 billion, $2 billion company, you'll get good service from Goldman Sachs. But Goldman's looking at the companies that are $50 billion and are looking to do a takeover of a 10 or 20 billion.
If you're a $2 billion company, you're not talking to Lloyd Blankfein on the phone.
You're probably not talking to Lloyd Blankfein on the phone. So I think there is a space for these boutique banks, and I think there's a potential for them to do well. However, when I look at the valuations right now, the valuations aren't great. Part of that is probably because this is a very cyclical business, and IPOs have been down. There hasn't been a ton of M&A activity. We've seen some life, but we don't exactly have a robust M&A market, and that's what these firms depend on. So you're going to see valuations go a little bit higher in the down part of the cycle. If the economy keeps picking back up, if we get more capital raising going on, if we get more M&A activity, you'll start to see those valuations go down, even as these stocks perform strongly.
Great.
Turning finally to the mortgage REITs, it's been a dream scenario turned into a nightmare.
Right.
As interest rates have shot up, these stocks have dropped like a rock. They're still paying dividends, and a lot of investors are hanging on because of those dividends, but the capital losses so far this year have been pretty astounding. Is there still a reason to be holding them? Is there a reason to be buying them? Is there potentially another dream scenario ahead for them?
I don't know if we're going to get to the dream scenario that we saw between 2009, end of 2009, and 2011. That was a great time. A lot of these stocks doubled on a total return basis, like American Capital Agency. That was a great stock to own over the last couple of years. Not so much the last couple of months, as you mentioned. So going forward, a company like AG&C or Invesco, Armor Residential, Two Harbors, these have all been completely whacked. So they've had their great run, and I think now the question is short-term positioning. And we don't like to talk a lot about short-term thinking, short-term investing here at The Fool, but it's going to be about short-term positioning if interest rates do start to go up. So can you just weather the storm on the book? It's going to take losses. We know it's going to happen as interest rates rise. Those securities will lose value. Investors need to be prepared for that. But a dream scenario is if the Fed came out and said, we want to keep short-term rates rock bottom. We want to keep overnight lending, short-term lending super, super low, and we're going to let long-term rates tick up to maybe 4%, 5%. That is the dream scenario where they can still capture that spread, continue paying those dividends to their investors, and slowly recover some of that book value.
Well, the spread will be nice, but even in that scenario, aren't you still worried about the book, the investment portfolio that these companies are carrying? And I think that's a lot of the reason why we've seen these big declines is that investors realize that the securities that are held on the balance sheet for these mortgage REITs are falling as interest rates rise.
It's a little bit of a short-term versus long-term. There is going to be short-term pain, and you have to be willing to accept that. It's going to fall. But if we do get to a steeper yield curve environment where they can make up that spread and continue to generate actual interest income for their shareholders, it will slowly make up for that. And that's when it really gets important to positioning. How is the management team positioning that book? So that's what investors really need to look for and listen to when these companies start to report second quarter earnings in a couple weeks, which will be very, very interesting.
Yeah, I hate to say it, but it is a little bit of a timing issue in terms of being an investor here. And I had actually been saying this for a little while, for maybe a couple of years before this, that we had such a good environment for mortgage REITs before. And that it was going to turn the opposite way when interest rates started to tick up, and now we're starting to see that. So I think it would have to be a little bit of an idiosyncratic situation for one of these to actually fail or go under. I don't think any of them are in that sort of position. It's just more of a question of how badly are these books going to get damaged from the drop in prices. And how quickly can they make up for that? So I think now we're starting to get into that part of the cycle where I think it makes more sense to start thinking about investing in these and looking at management, looking for the best management teams, the ones you want to invest in over the long term. Two Harbors, I think, is a good example. What I've seen from them gives me a lot of confidence. Unfortunately, that stock hasn't fallen as much as the other mortgage REITs, so maybe I'm not the only one that's recognized the good management there.
Absolutely.
For David Hanson, I'm Matt Koppenheffer. Thanks for watching, folks. We'll see you tomorrow.